Hey guys, Denver here. So I've been working tirelessly to try to figure out what in the heck Trump is up to. And I think I know what's up. So for weeks and weeks and weeks now, I've just been tirelessly trying to figure out, okay, is he doing this? Is he doing that? Is he, what could possibly be the end game here? And here's what I think happened. At first, I thought that he was potentially simply trying to cause chaos in order to put himself in a better negotiating position with the USMCA, the trade agreements between Mexico and Canada. However, I think that's a secondary thing. I think that's something that's just a benefit on the side. Because if you listen to last week, a couple of the two main guys that are advising him, both explicitly brought up the 10-year treasury yield. Well, why is that important? Well, here's why. The 10-year treasury yield is essentially what dictates interest rates, mortgages, loans on vehicles, pretty much anything that makes it easy to borrow money, which is kind of how people get capital. And that's how they invest, that's how they buy new things. And without those yields coming down, the housing market's gonna stay down, vehicle purchases, new washer dryers, homes, everything. So Trump literally came out and said, I want to get the 10-year yield down. He didn't directly say it, but he pretty much did. He basically said that, as well as the other two advisors that he's working with. One of them being a gentleman from the old school stock market who is well known in that area, and yet he's not coming out and directly talking about stuff like that. You know what I mean? He's just talking about the borders and fentanyl and all this kind of stuff. Come on, you're crashing an entire economy and basically eventually the world economy to drop 0.05 pounds of fentanyl on Canada's border in the past month. Yeah, that's insane. So why is that a big thing? Here's why. The 10-year treasury yield is not just going to drop. It's not just going to go down in a couple of days, probably even a couple of weeks. It's going to take a couple of months. And they're going to want to see that it stays down, because generally speaking, once they take their foot off of the brakes here, it'll start spiking right back up. So it may take a few months, even 3-4, right? And in that time, if he's being this ambiguous, if he's being this kind of all over the place, what he's really going to end up doing is totally smoking the market. I think the market will start getting used to it in, sooner than later. I don't know when though. I don't have a crystal ball, but the stock market's probably going to have a little more pain, but it also means there's opportunities here. So how do you protect the best against that? I'll tell you what I'm doing. I'm going to be buying the TLT, probably options on the TLT. What happens is that the TLT is a representation of the value of bonds at their current rate. So if you have a 5% bond right now that you own, and let's say currently the treasury yield is 5%, so the interest rate, but then the interest rate goes down to 3.5%. Well, the value of that 5% bond goes up now because you can only get a bond now at paying a 3.5% ticket rate. So essentially, if you buy the TLT, right, an option on the TLT, whatever, the value of that at the current rate of 4.3% will go up and up and up as the yields on the 10-year bond come down and down and down. Let's say down to 3.5%. You can make a pretty decent amount of money, and that will hedge your portfolio on its way down, because honestly, we don't know where the bottom is. We're already down 8% on the S&P, 10 or 11 on the NASDAQ. But yeah, so here's what's going on. And the other benefit of that is you guys have probably heard about Tom Lee talking about, for quite a while now, for well over a year and a half even, he's been talking about the Russell 2000, the small cap index coming up. What is the number one thing that brings that thing back up? Treasury yields coming down. Interest rates coming down. Why? Because small businesses have to borrow at the current interest rates. They don't have any benefits like huge companies like Meta, Amazon. These types of guys, or these types of companies, essentially make huge money off of their extra cash on their balance sheets, simply by putting them into treasury yields at 5, 6, money market funds 6, 7, 8%, and risk free. And the money's just going to be sitting there anyways until they do research and development. Whereas small companies, they're kind of always needing more money to keep the thing going because they're in the growth stage, and usually they're not even profitable, which means that they're constantly having to take new money from other places, diluting shares by giving people that they bring on more shares for the business. And if they don't do that, then they have to borrow money from usually at a higher interest rate from other places. But if the bond yields come down, they can borrow straight from banks at a much lower interest rate, which essentially means that they're not burning through money as quickly. So that immediately means that the Russell 2000 and small caps will come up. So this is what I think is going on. I think it's pretty clear at this point. So this is the way that you can protect yourself. And yeah, I'll see you guys again.